It means a lot to me. What I've learned in life, both as an investor but as a lender, is that asset values are ephemeral. They rise and fall. But obligation, debt, is fixed, and money good. Specifically, the debt to GDP number is relevant because it means that if we had the replay of a circumstance like 2008, a liquidity crisis, our ability for credit markets to allow us to print our way out of the difficulty, to increase liquidity through quantitative easing, gets less and less. Coming into 2008, federal debt, on-balance sheet debt, relative to GDP was about 40%. That same number today is 3 times higher. The tolerance of credit markets for counterfeiting will decline, which means that our ability, our fiscal ability to deal with liquidity crises declines. Could it work one more time? Sure, maybe. Maybe's a rough word. It's all a function of confidence. We could afford to be more confident when on-balance sheet liabilities were 40% of GDP than we can where on-balance sheet liabilities are 120% of GDP. But people look at these numbers and they think they're abstract. Let's transpose those to a person. Let's decide that your gross earnings for a year are going to be $100,000. And let's decide at the beginning of the period that you have $40,000 in debt. After all of your other expenses, you can likely service $40,000 in debt at a reasonable interest rate. Let's say that, however, 20 years hence that your salary is $100,000 and your debt is now $120,000. Sometimes it's useful to scrape all of the zeros off the number and to personalize the potential impact of the debt. Sometimes that helps people. But Patrick, the second area of concern, and by the way, I'm not one of these doom and gloom guys, but the second part of the concern goes around a number that nobody talks about. That is the $100 trillion in the net present value of promises that we've made to ourselves, entitlements. I believe that we will honor the nominal value of those entitlements. Let me put that in perspective. Some old codger, let's say Rick Rule, 71-year-old guy. I don't know what Social Security has promised me, maybe $4,000 a month. I don't know, $3,000. I have no idea, to be honest with you. Society's going to keep that promise. They're going to continue to pay me my $4,000 a month. But they're going to inflate away the net present value of the obligation. Did you know, Patrick, you probably don't because you weren't alive then, that in the decade of the 1970s, according to the IRS, the purchasing power of the US dollar in 10 years, 1970 to 1980, declined by 75%. I believe that Medicare obligations on a nominal basis and Social Security obligations on a nominal basis and federal pensions and military pensions on a nominal basis will be honored. But I think the purchasing power of those nominal payments will be reduced by 75% in the next 10 years. In other words, some old codger like me will get $4,000, but $4,000 will buy $1,000 in goods and services. That's how we deal. That's how we'll deal with the debt and the deficits. So be prepared. I would argue that we've already seen the return of inflation. The big thinkers in the world would have you measure inflation as the CPI. We laughingly call that the CP lie. The CPI, when it's inconvenient, doesn't include food or fuel. What use is an inflation measure that doesn't include breakfast, lunch, or dinner? The second thing it does is it doesn't value the cost of goods and services. It assigns arbitrary value to them. It is hedonistically adjusted, meaning that the people who construct the index construct the values. But the silliest part about the CPI is it doesn't include tax. I would ask your listeners to do a thought experiment. Take the period, if you will, 2000 to 2024, and ask yourself whether your cost of living has increased at 2.6% or some higher number. I would suggest that if you measure inflation personally, and you describe it as the deterioration in the purchasing power of your savings and investments, that the purchasing power of the US dollar is declining by more like 7.5% compounded. Over the last 4 years, Patrick, well, you don't live in the United States, so maybe it isn't fair to ask you. Has gasoline gone up 2.6%? Have grocery prices gone up 2.6%? Has health insurance and health care gone up 2.6%? How about rent? The mortgage interest rate has doubled. And how about taxes? The idea that inflation, as I define it, the deterioration in the purchasing power of US dollar savings, is marching along at 2.6% is to me farcical. I'm amused that the people who vote and the people who work and invest now believe that these inflation measures, by measures, I mean the methodology that's used to measure inflation and index, is accurate, because it's fiction. It's pure fiction. This isn't a Democratic statement, Patrick. This isn't a Republican statement. This is simple arithmetic. Inflation is with us. We are in a circumstance that, left to its own devices, would be broadly deflationary. When you liquidate at the end of a credit cycle, when you have defaults, that's deflationary. The policy response to that is inflationary. In other words, we postpone the reckoning around the debt by inflating away the net present value of the debt. We're living in an artificial construct, and I think we're going to live in an artificial construct for the rest of my natural life. What that means as an individual is that you need to understand, if you are on a defined benefit pension plan, or if you think that your university education in the future is going to be funded by an endowment, if you're counting on Social Security or Medicare or Medicaid, understand that you're going to have to make other arrangements. If you are planning for retirement, and if your thinking is around nominal pricing, which is to say, if you have an adequate life now with retirement income of $5,000 or $6,000 a month, and you project forward 10 years, understand that your $5,000 or $6,000 a month will buy you $1,500 worth of goods and services at today's prices, looking forward. And you need to make private arrangements to deal with that. And it's important that you begin to do it now. According to the IRS, Patrick, as I said, in the decade of the 1970s, the last time we faced this circumstance, according to government statistics, not some cranky old libertarian Rick Rule, according to government statistics, the US dollar lost 75% of its purchasing power in 10 years. Not coincidentally, the gold price soared. I think it's important to note, too, for all its faults, the US currency is still the best currency in the world. So if you live outside the US, my suspicion is that your outcome will likely be worse, not better. Unless you live in demi-states, Singapore, where you do, as I understand it. But for Americans, I'm not suggesting doom and gloom. I'm just suggesting that if you rely on the Commonwealth in the old-fashioned sense of the word for your future, you're mistaken. You need to rely on yourself. I think the dollar will do well relative to other currencies, but I think the dollar will do very poorly in isolation. Let's look at the arithmetic around the U.S. 10-year Treasury, Patrick, in answer to your question. The Treasury pays you 4.4%. And if you believe the CPI stated rate of inflation at 2.6, you're getting a 2.2% real yield. Not great, not bad. You know you're going to get paid, because if they need to, they can print to pay you. But if you change your inflation assumptions to reflect real arithmetic, what you see then is that the purchasing power of your yield and your principal is declining by 7.5% compounded. Now that's brand new arithmetic.